Did you know that only 5 out of the 50 United States require high school students to take a semester on personal finance? Those states being Utah, Missouri, Tennessee, Alabama, and Virginia. That's just 10% of the entire country. It's no surprise that this is why people don't know what to do with their money and spend their entire adult life learning by trial and error. Even those states that teach the semester on personal finance does not guarantee that you have the best financial advice. Now, if we were to place the entire U.S. population in this box, only the top 5% will receive the best financial guidance, and the remaining 95% are left to fend for themselves. I'm here with you today because I want to bridge that gap by educating the 95% about the fundamentals of wealth. In elementary school, we are taught about how to use long division only to never use it again. Well, it just became relevant again. The rule of 72 is a simple division exercise that shows you the amount of time it will take for your money to double based on the interest rate that your bank pays you. Now, you may ask, where do most people place their money? You guessed it, in a bank, in either a checking or savings account. Checking accounts pay no interest to hold your money, while savings accounts, the generic ones, will pay an average of 0.01% a year. Yeah, you heard that correctly. Now, if you use the rule of 72, 72 divided by 0.01%, it'll take your money approximately 7,200 years for your money to double. Most people won't be around to see their money double after 7,200 years. And it's no surprise that most Americans use savings accounts because they just don't know where to put their money or know the rule of 72. Applying this rule, there are 3 things your money needs to do in order for it to prosper. The first thing is time and the power of not wasting it. In this example, let's say we have 2 friends that both graduated from college. Both are hired immediately and have started their professional careers. Of the 2 friends, one is responsible and disciplined, thinking ahead to secure his financial future. The other wants to party and travel for 2 years because life is short and you only live once. Friend A, the responsible one, begins saving $5,000 a year in a Roth IRA that's paying 10% a year in interest at age 25. After 2 years, your other friend decides to settle down and wants to start the same saving plan as you, $5,000 a year at 10%. And he wants to retire at age 65, just like you. After 40 years of saving $5,000, you will have put away $200,000. But because you were earning the 10% interest, you actually earned $2,200,000. Your friend who wants to retire at age 65 also only saved for 38 years because he spent the first 2 partying and traveling around, which would end up being a total of $190,000. With the 10% interest applied, he actually earned $1,800,000. Now you both are pretty happy, but when your friend realizes that you earned $400,000 more because you started 2 years earlier, he gets a little bit upset. Those $10,000 of saving cost him $400,000. Moral of the story, don't wait to start saving. Start today. Rate of return is the second point I want to hit. As mentioned before, the rule of 72 will show you the amount of time it will take for your money to double. In this scenario, let's say your grandmother gave you about $5,000 to invest. You shopped around and found a bank willing to pay you a 7% interest, and she wants you to make the best decision possible. Now, we know this is unrealistic, but for the sake of this example, let's say it's true. You take that money at age 25 and invest it, so you start at $5,000. Based on the rule of 72, your money will double every 10 years. So at 35, you'll have $10,000. At age 45, you'll have $20,000. At age 55, you'll have $40,000. And at age 65, you will have retired with a total of $80,000. Now you take this money, and at age 65, your grandma, although no longer around, would say she's pretty proud of you for the choice that you've made. Now you go pull that money from the bank. What do you think the money did with all that money with all your money while it was growing? Put it in a vault with a bow and your name tag? No. they lend it back to you in the form of credit cards, auto loans, and mortgages. They also went out and invest your money at much higher rates, usually double digits. Let's say they reinvest your hard-earned money at 14.4%. Doing the math with the rule of 72, that money will double every 5 years. So they take that $5,000 and invest it. At 30, they'll have $10,000. When you're age 35, they'll have $20,000. When you're age 40, they will have $40,000. At age 45, they will have $80,000. At age 50, they will have accumulated $160,000, 55, $320,000. At age 60, they will have $640,000. And at age 65, you will have $1,280,000. So that bank will have zero problems giving you your $80,000 at age 65 because they just made $1.28 million from you. If these rates are out there, why do you think 95% of this country is going out and settling for 0.01%? Well, in short, it's basically because they just don't know. The good thing is that we show people how to get these rates no matter what your net worth is. The third thing I want to cover, and that your money needs in order for it to prosper, are tax advantages. At every which way you turn, you get taxed. You get paid from your job, you get taxed. You save your money in a savings account and it grows, you get paid on the capital gains. You get taxed on the capital gains. You go shopping, you pay sales tax. If you leave an estate for your family, then you will likely pay a death tax. If there was a way to lower these taxes, most people would want to figure that out. Well, there are 3 ways your money gets taxed. It's important to understand all of them. Now, later, and exempt from taxes. First off, taxable money. Your taxable money is good for the short term because it's liquid, just like a fountain, and it's readily accessible. Examples of these include savings accounts, certificates of deposits, and money markets, and mutual funds. Problem here is, as your money grows, it's taxed. As it continues to grow, it's taxed some more. The challenge then becomes the rate of return in the common places where people put their money. For example, if you're at Wells Fargo, Bank of America, Chase, they're paying you 0.01%. You can Google that. And one thing people don't take into account sometimes is inflation, which is about 3% each year. If you're earning 0.01% and inflation is 3%, then you're practically paying the bank to hold your money for you. Last but not least, tax deferred. In this type of retirement vehicle, you use pre-tax dollars from your income and invest them into the market. The money invested here is deferred or not taxed as the money grows. It's where most people save their money. And if you work with a company or have benefits package with your job, you likely have a 401k. Other examples include 403bs, 457s, and traditional IRAs. People who are approaching retirement think that the balance on their 401ks is there to pocket. Little do they know, and at times aren't thoroughly educated by the HR person at work, that 30 to 60% of that money will be given to their family. And by family, we're talking about Uncle Sam. Last but not least, we're going to talk about tax exempt. In this method, the money invested is taxed on the way in, but grows income tax free. In other words, all the capital gains belong to you. Examples of tax exempt vehicles include Roth IRAs, cash accumulation inside a life insurance policy, and municipal bonds. We hope you found this information to be of value and that you learned something today. Based off of the information, you might have some questions. Or you may want to learn more about some of the examples that are shown in this video. If any of these are the case, I encourage you to schedule a complimentary consultation. All you have to do is fill out your name, phone number, and email, and we'll get in touch with you shortly. Looking forward to servicing you.